I'd like to welcome you to, we got a lot of out-of-towners here, and I'd like to welcome you to Omaha. It's a terrific, it's a terrific city, and Charlie's lived in California now for about 70 years, but he's still got a lot of Omaha in him. Both of us were born within 2 miles of this building that you're in. And Charlie, as he mentioned in his description of his amorous triumphs in high school, Charlie graduated from Central High, which is about 1 mile from here. It's a public school. And my dad, my first wife, my 3 children, and 2 of my grandchildren have all graduated from the same school. In fact, my grandchildren say they've had the same teachers that my dad. It's a great city. I hope you get to see a lot of it while you're here. And in just a minute, we will start a question period, hopefully a question and answer period, that will last till about noon, and then we'll take a break for an hour or so. We'll reconvene at 1, and then we'll continue with the question and answer period till 3:30, and then we'll break for 15 minutes or so, and then we'll convene the annual meeting of Berkshire, which we have 3 propositions that people wish to speak on, so that could last perhaps as long as an hour. Before we start, I'd like to make a couple of introductions. The first being Carrie Silva, who's been with us about 7 years. And can we have a light on Carrie? I think Carrie, are you there? Stand up, Carrie, come on. Carrie puts on this whole program. She came with us about 7 years ago, and a few years ago I said, why don't you just put on the annual meeting for me? And she handles it all, and she has 2 young children, and she has dozens and dozens and dozens of exhibitors that she works with, and as you can imagine, with all of what we put on and all of the numbers of you that come, the hotels and the airlines and the rental cars and everything, she does it as if she could do that and be juggling 3 balls at the same time. She's amazing, and I want to thank her for putting on this program for us. I also would like to welcome and have you welcome our directors. They will be voted on later. So I'll do this alphabetically. They're here in the front row, and if we could just have the spotlight drop on them as they're introduced. And alphabetically, there's Howard Buffett, Steve Burke, Sue Decker, Bill Gates, Sandy Gottesman, Charlotte Guyman. We have Charlie Munger next to me. Tom Murphy, Ron Olson, Walter Scott, and Merrill Whitmer. Yeah. One more introduction I'm going to make, but I'll save that for just a minute. And our earnings report was put out yesterday. As we regularly explain, the realized investment gains or losses in any period really mean nothing. I mean, we could take a lot of gains if we wanted to, we could take a lot of losses if we wanted to, but we don't really think about the timing of what we do at all, except in relation to the intrinsic value of what we're buying or selling. We do not make earnings forecasts, and we have, on March 31st, we have over $90 billion of net unrealized gains. So if we wanted to report almost any number you can think of and count capital gains as part of the earnings, we can do it. So in the first quarter, and I would say that we have a very, very, very slight preference this year, if everything else were equal. Well, it's true in any year, but it's a little more so this year. We would rather take losses than gains because of the tax effect if two securities were equally valued. And there's probably just one touch more of emphasis on that this year because we are taxed on gains at 35%, which means we also get the benefit, the tax benefit at 35% of any losses we take. And I would say that there's some chance of that rate being lower, meaning that losses would have less tax value to us after this year than they would have after this year than this year. That is not a big deal, but it would be a very slight preference, and it may get to be more of a factor in deferring any gains and perhaps accelerating any losses as the year gets closer to December 31st, assuming, and I'm making no predictions about it, but assuming that there were to be a tax act that had the effect of reducing the earnings. So in the first quarter, insurance underwriting was the swing factor, and then there's a lot more about this in our 10Q, which you can look up on the internet. And you really, if you're seriously interested in evaluating our earnings or our businesses, you should go to the 10Q because the summary report, as we point out every quarter, does not really get to a number of the main points of valuation. I would just mention two factors in connection with the insurance situation, which I love. In the first 4 months, not the first 3 months, but the first 4 months, GEICO's had a net gain of 700,000 policyholders, and that's the highest number I can remember. There may have been a figure larger than that somewhere in the past. I did not go back and look at them all. But last year, I believe that figure was like 300,000, and this has been a wonderful period for us at GEICO because several of our major competitors have decided, and they publicly stated this. In fact, one of them just reiterated it the other day, although they now changed their policy. But they intentionally cut back on new business because new business carries with it a significant loss in the first year. There's just costs of acquiring new business. Plus the loss ratio, strangely enough, on first-year business tends to run almost 10 points higher than on renewal business. And so not only do you have acquisition costs, but you actually have a higher loss ratio. So when you write a lot of new business, you're going to lose money on that portion of the business that year. And we wrote a lot of new business, and at least two of our competitors announced that they were lightening up for a while on new business because they did not want to pay the penalty of the first year loss. And of course that's made to order for us, so we just put our foot to the floor and try to write as much business, good business as we can, and there are costs to that. A second factor, well, it's not a factor in the P&L, but an important event in the first quarter is that we increased our float. And on the slide, I believe it shows it year over year, 16 billion. 14 billion of that came in the first quarter of this year. So we had a $14 billion increase in float. And for some years, I've been telling you it's going to be hard to increase the float at all. And I still will study the same thing. But it's nice to have $14 billion or more, which is one reason, if you look at our 10Q, you will see that our cash and cash equivalents, including Treasury bills, now has come to well over 90 billion. So I think I feel very good about the first quarter, even though our operating earnings were down a little. But one quarter means nothing. I mean, over time, what really counts is whether we're building the value of the businesses that we own. And I'm always interested in the current figures, but I'm always dreaming about the future figures. There's one more person I would like to introduce to you today, and I'm quite sure he's here. I haven't seen him, but I understood he was coming. there's I believe that he's made it today, and that is Jack Bogle, who I talked about in the annual report. Jack Bogle has probably done more for the American investor than any man in the country. And Jack, could you stand up? There he is. Jack Bogle, many years ago, he wasn't the only one that was talking about an index fund, but it wouldn't have happened without him. I mean, Paul Samuelson talked about it, Ben Graham even talked about it, but the truth is it was not in the interest of the investment industry of Wall Street. It was not in their interest actually to have the development of an index fund, the index fund, because it brought down fees dramatically. And as we've talked about some in the reports and other people have commented, index funds overall have delivered for shareholders a result that has been better than Wall Street professionals as a whole. And part of the reason for that is that they brought down the costs very significantly. So when Jack started, very few people, certainly Wall Street, did not applaud him. And he was the subject of some derision and a lot of attacks. And now we're talking trillions when we get into index funds, and we're talking a few basis points when we talk about investment fees in the case of index funds, but still hundreds of basis points when we talk about fees elsewhere. And I estimate that Jack, at a minimum, has left in the pockets of investors without hurting them overall in terms of performance at all, gross performance. He's put tens and tens and tens of billions into their pockets, and those numbers are going to be hundreds and hundreds of billions over time. So it's Jack's 88th birthday on Monday. So I just say happy birthday, Jack, and thank you on behalf of American investors. And Jack, I've got great news for you. You're going to be 88 on Monday, and in only 2 years, you'll be eligible for an executive position at Berkshire. So hang in there, buddy. Okay, we've got a panel of expert journalists on this side and expert analysts on that side and expert shareholders in the middle, and we're going to rotate, starting with the analysts, and somewhere here I have here we go. And we'll do this through the afternoon. If we get through 54 questions, which would be 6 for each journalist, 6 for each analyst, and 18 more for the audience, then we will go strictly to the audience. I don't think I've got any information as to what the situation is on overflow rooms, but we'll go to at least one of them. But let's start off with Carol Loomis of Fortune magazine, the longest-serving employee in the history of Time Inc., I believe, with 60 years. And Carol, go to it.
Thank you. Thanks from all of us journalists up here. I know that there are many, many people out there who have sent us questions that aren't going to get answered. And I just want to say that it's very hard to get a question answered. The one thing I can suggest is you follow Warren's thought in the annual report that he wants everybody to go away from this meeting more educated about Berkshire than they were when they came. And one way you can do that is keep your questions quite directly Berkshire related or relating to the annual letter. Even then, it will be hard to get your question answered. The three of us only have 18 questions in total. Commissioned an investigation and hired a large law firm to assist in carrying it out. The findings of the investigation, which were harsh, have been released in what is called the Wells Fargo Sales Practices Report. You can find it on the internet. It concludes that a major part of the company's problem was that, and I quote, Wells Fargo's decentralized corporate structure gave too much autonomy to the community bank's senior leadership, end of quote. Mr. Buffett, how do you satisfy yourself that Berkshire isn't subject to the same risk with its highly decentralized structure and the very substantial autonomy given to senior leadership of the operating companies?
Yeah, it's true that we at Berkshire probably we certainly operate on a more decentralized plan than any company of remotely our size. And we count very heavily on principles of behavior rather than loads of rules. It's one reason at every annual meeting you see that Solomon description, and it's why I write very few communiques to our managers, but I send them one once every 2 years, and it basically says that we've got all the money we need. We'd like to have more, but it's not a necessity. But we don't have 1 ounce of reputation more than we need, and that our reputation at Berkshire is in their hands. And Charlie and I believe that if you establish the right sort of culture, and that culture to some extent self-selects who you obtain as directors and as managers, that you will get better results that way in terms of behavior than if you have a 1,000-page guidebook. You're going to have problems regardless. We have 367,000, I believe, employees. Now, if you have a town with 367,000 households, which is about what the Omaha metropolitan area is, people are doing something wrong as we talk here today. There's no question about it. And the real question is whether the managers are worrying and thinking about finding and correcting any bad behavior, and whether if they fail in that, whether the message gets to Omaha and whether we do something about it. At Wells Fargo, there were 3 very significant mistakes, but there was one that dwarfs all of the others. You're going to have incentive systems at any business, almost any business. There's nothing wrong with incentive systems, but you've got to be very careful what you incentivize. And you can't incentivize bad behavior, and if so, you better have a system for recognizing it. Clearly, at Wells Fargo, there was an incentive system built around the idea of cross-selling and number of services per customer, and the company in every quarterly investor presentation highlighted how many services per customer. So it was the focus of the organization, a major focus, and undoubtedly people got paid and graded and promoted based on that number, at least partly based on that number. Well, it turned out that was incentivizing the wrong kind of behavior. We've made similar mistakes. I mean, any company's going to make some mistakes in designing a system, but it's a mistake. And you're going to find out about it at some point, and I'll get to how we find out about it. But the biggest mistake was that, and I don't know, obviously I don't know the facts as to how the information got passed up the line at Wells Fargo, but at some point, if there's a major problem, the CEO will get wind of it. And that is, at that moment, that's the key to everything, because the CEO has to act. That Solomon situation that you saw happened because on April, I think, 28th, the CEO of Solomon, the president of Solomon, the general counsel of Solomon, sat in a room, and they had described to them by a fellow named John Merriweather some bad practice, terrible practice that was being conducted by a fellow named Paul Mosher who worked for him. And Paul Mosher was flim-flamming the United States Treasury, which is a very dumb thing to do. And he was doing it partly out of spite because he didn't like the Treasury and they didn't like him. So he put in phony bids for U.S. Treasuries and all of that. So on April 28th, roughly, the CEO and all these people knew that they had something that had gone very wrong, and they had to report it to the Federal Reserve Board in New York, the Federal Reserve Bank in New York. And the CEO, John Goodfriend, said he would do it, and then he didn't do it. And he undoubtedly put it off just because it was an unpleasant thing to do. And then on May 15th, another Treasury auction was held, and Paul Mosher put in a bunch of phony bids again. And at this point, it's all over because the top management had known ahead of time, and now a guy that was a pyromaniac had gone out and lit another fire, and he lit it after they'd been warned that he was a pyromaniac, essentially. And it all went downhill from there. It had to stop when the CEO learns about it. And then they made a third mistake, actually, but again, it pales in comparison to the second mistake. They made a third mistake when they totally underestimated the impact of what they had done once it became uncovered, because there was a penalty of $185 million, and in the banking business, people get fined billions and billions of dollars for mortgage practices and all kinds of things. The total fines against the big banks, I don't know whether it totals 30 or 40 or billion or whatever the number may be. So they measured the seriousness of the problem by the dimensions of the fine, and they thought a $185 million fine signaled a less offensive practice than something involved $2 billion, and they were totally wrong on that. But the main problem was they didn't act when they learned about it. It was bad enough having a bad system, but they didn't act. At Berkshire, we have the main source of information for me about anything that's being done wrong at a subsidiary is the hotline. Now we get 4,000 or so hotline reports, or that come, we get communications on the hotline, perhaps 4,000 times a year, and most of them are frivolous. You know, the guy next to me has bad breath or something like that. I mean, but there are a few serious ones, and the head of our internal audit, Becky Amick, looks at all those people. A lot of them come in anonymous, probably most of them, and some of them she refers back to the companies, probably most of them. But anything that looks serious, you know, I will hear about, and that has led to action. We'll put it more than once, and we spent real money investigating some of those. We put special investigators sometimes on them, and like I say, it is uncovered certain practices that we would not at all condone at the parent company. I think it's a good system. I don't think it's perfect. I don't know what, I'm sure they've got an internal audit at Wells Fargo, and I'm sure they've got a hotline, and I don't know the facts, but I would just have to bet that a lot of communications came in on that, and I don't know what their system was for getting them to the right person, and I don't know who did what at any given time. But it was a huge, huge, huge error if they were getting, and I'm sure they were, getting some communications and they ignored them, or they just sent them back down to somebody down below.